Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap in Capitalize. And on today's episode, my special guest was none other than Kevin Howard. Now, Kevin Howard is a fascinating individual. And his resume is beyond excellent. He was a banker during the Great Financial Crisis. He worked for and worked with Fannie Mae, Freddie Mac. And so he saw things that, frankly, mere mortals could not begin to fathom. But above and beyond that, he is an author, a fellow author. And what we discussed today was not so much his book. I'll let you look him up. But what we discussed today were things that were a little bit controversial. We talked about tariffs, we talked about DOGE, we talked about what could be happening as Fannie Mae and Freddie Mac could be taken private. We talked about the big banks, the too big to fail banks, and which ones could survive and which ones may not in the at the very end of it all, because there's a lot of consolidation in the world of banking. But tune into this episode and you will discover everything that you need to know about all of these topics, and there are going to be some bonus tidbits. So sit back, relax, enjoy Kevin and my discussion on Capitalize Your Finances. Because this isn't your first live.
No, not at all.
That's right. Is this your second? Because you've done a couple of these.
Yeah, no, I definitely have more than a few, because I've done the book was originally published in December 2022.
Yeah.
And so I did a round of promotions then.
Yeah.
And then I did an update for the general election
last
year. And so no, I would say probably maybe about 4 or 5 lives in this.
Yeah. Well, and the reason why I ask is it's interesting because a lot of people, they'll come in and I get it. Zoom is so valuable and it saves so much time, but there's no comparison to this. I mean, you just don't. I've gotten to a point where, I'll do guest appearances on Zoom, but it just hits different in person, man. And then, you got the camera that doesn't work or the mic goes out or whatever. And then also what I've noticed is a lot of these people, not everyone, because there are some shows that are, in fact, a lot of these podcasts, the best in the world, they're not in person, but you see people and they're asking you questions. And they're like looking at their phone. And so they're like, all right, Kevin, so, what's your thought? And it's like, dude, what are you even doing? It's an absolute pain. And so the reason is I hope more of these conversations are coming back into flavor of the norm as opposed to the Zoom side of things.
I do think that's happening because people want the authenticity.
Yeah.
Like you said, Chris.
And it's an experience, I probably just lost any sponsorship opportunity with Zoom ever, But I've been excited to have you in. And this has been, by the way, thanks for coming in. This has been a long time coming.
Yeah.
And I was thinking about it too, because a lot of my listeners, they don't know who you are, but they will after this episode. And at the very end, we may talk about your book a little bit. However, when we first spoke and with your background in banking and Fannie Mae and Freddie Mac and just being an economic unknown and untapped wizard that you are, there were some things that I definitely wanted to chat with you about. Sure. And the first one, which is completely not controversial, is the side of tariffs. Yes. Okay. And it's interesting. I wanted to get your take first off, and then we'll just kind of freeball it from here on what your not necessarily opinion is, but what do you see the U.S. resulting in with these possible tariff opportunities, pros, cons? A lot of people don't even know what the heck a tariff even is. So I'm just curious, like, enlighten me in my listeners, and let's just go with it because it's going to be a lot of fun.
Yeah, no, what a great question, and very, very timely, because I do think that this is not really being covered properly.
Yeah.
Primarily, the way it's being covered right now is President Trump is using tariffs as a sort of a negotiating tool.
Yeah.
To kind of rejigger some of trade agreements and some relationships for U.S. multinational corporations to have a better environment, better playing field, let's say, overseas where it hasn't been, quote unquote, fair, as he would put it.
Sure.
And but actually what he's campaigned on and the basis of his mandate, see, you have to get into that to really understand the magnitude of what we're talking about here. Because his concept of tariffs is bringing us back to a regime that we had 100 years ago.
Yeah.
And so
100 plus, if you think
plus, right.
Well, and also people don't, and I don't mean to cut you off, but like people don't understand that tariffs have been around for, like, this isn't some new concept.
It's not a new concept. What is going to be new is this. So Trump represents the anti-establishment burgeoning governing majority in this country. And what he intends to do with tariffs is reverse the globalization that we started back in the 80s, leading into the 90s, and which did not serve the base that elected him, which left the American middle class and the American working class behind. Very much the same way with what happened in Great Britain with Brexit. The reason why the population voted to exit the European Union is because the economics of that union was favoring the professional class and wealth at the expense of the middle class, the domestic middle class and the working class. And that is exactly what happened in the United States over the last 35 years, is that you had this, basically U.S. multinational corporations were able to access quality labor at the discount price by playing the global market, effectively commoditizing U.S. labor.
Yeah.
We deindustrialized the country. And what that left was a situation where we had an American working class who could buy a house, who can actually send their child to local college or whatever.
Yeah.
Now we have an American middle class. The average American middle class family can't afford to buy a home in the average American city, right? Okay, so how did that happen? Well, the profitability and the benefits of technology and globalization over the last 35 years have concentrated more of the wealth near the top.
Yeah.
It's just statistically and factually true.
Well, I mean, compounding works in every aspect of your life.
Oh yeah, absolutely.
I mean, so if you have $100,000 and you double it, you have $200,000. Well, if you have $1 million, you double it. The double is still the same, but from an absolute standpoint, you got another $1 million. Like there comes a point where you're just not going to catch up.
This is true, but
yeah.
But so why this is relevant, particularly to your audience, particularly from an investor or a business entrepreneurial perspective, because I come out of commercial banking, I come out of business banking. I have financed and customized financial services for startup operations all the way up through the middle market. And I can tell you, one of the things I saw, particularly in the first 20 years, particularly of the first 10 years of the 2000s, from 2000 to 2010, is these factors, these geopolitical factors, globalization, the impact they had on the entrepreneur is it caused new business formation to slow down dramatically. Why? Because the entrepreneurs, the source of new business formation was people like you and I, who had an idea, who's developing skills, who's saving up a little money so that they can put some capital in and they don't have to borrow everything and be hyper leveraged. And that's how businesses were started and new entrepreneurs were generated and new American dreams were found.
Sure.
Okay? As the working class and middle class, as their discretionary income started to decline, because so many of the quality jobs went abroad, and what was left over, was not as valuable. And so therefore they had less discretionary income. Their capacity to start a business decline. These were the customers I was servicing. All of a sudden, it's not that you couldn't find people, but people who had the same dreams.
Well, it got harder to find.
Well, yeah, they absolutely.
Yeah. I can make an argument. It's harder to find people now more than ever.
Well, because so many people are on the hamster wheel, and I mean the bad hamster wheel.
Yeah.
Success is about the grind. Success is about working extremely hard
Yes.
as you work extremely smartly.
Yeah.
Right? But the problem is so many people are just working extremely hard.
Yeah.
2 or 3 jobs, 100 hours a week, whatever they're doing, and they're barely, again, they're not, it's not like it's producing something that allows them to save.
Yeah.
I mean, 60% of the country can't afford a $1,000 unexpected expense. 60% of the country. Okay, so it is these factors that produce the governing coalition that elected Trump. And so what he's doing with tariffs is he's endeavoring to reverse globalism, and it hasn't been done before. Now that's the the mystery.
Well, it's interesting you say that because it hasn't, but it also kind of has. So when all of this came out, first off, most people didn't even know what the heck a tariff even was until like regardless of how you feel about the economy, the administrative state, like doesn't matter. 99% of people didn't even know what the heck a tariff even was. Okay. And so just even backtracking, because I actually looked up the literal definition. Tariffs are imposed by governments to raise revenue, protect their domestic industries, and or exert political leverage on another country. And the reason why I bring that up is a lot of people were hitting me up. They're like, okay, well, what's your take on this? I'm like, okay, well, I got to get back to the drawing board here because like with what I do as a planner, does that relate? I can make an argument, yes and no, right, to what I do. I mean, indirectly, yes, what's going on in the economy could, in fact, relate directly to an investment or investments that I or clients or anyone has. But that's a whole nother story. So for me, I'm thinking, okay, so with the tariff, I get it. I get why these countries are using tariffs, not just the U.S. Okay, yeah. Like there's a give or take. Also, really quick side note, and then we'll get back to this. Over time, how globalization, a lot of these jobs have gone abroad and all that. I don't knock anyone for playing the game.
No,
like I totally get it. But to your point on globalization now, how it's starting to shrink or that's never really been done before, I would almost, it's not even an argument, but I'm curious your take because I would say in 2022, Poland, Hungary, I may have been Austria, I can't remember exactly, were pushing hard on individual nationalism, right? Like basically closing their metaphoric borders and making sure that they can make as much in-house. Now, in their defense, I mean, Poland has had the crap kicked out of them for years. I mean, they've been a sniff, cough, and fart away from being dead for like 80 years. And now they've come in and go, no. Like we need to wrap this up because we need to survive. Like it's survival. The blessing that the U.S. has is, I mean, regardless of people's opinions, okay, we've got Canada in the north, Mexico in the south, and a whole hell of a lot of nothing on either side. And, yes, it can be a little tense right now with Canada and Mexico for a number of reasons, but it's not like Poland where you've had, I mean, think about World War II. You had Russia knocking on your door, just gunning you down. And then on the other side, you had Germany gunning you down before Germany kind of imploded. And so and that, even after World War II, for years, they were just, because when the war is done, it's not like, oh, you're back to normal. Right. That's like saying like, oh, the LA fires are done. Like in a day, everything's going to be built. That's not how it works. And so now Poland I think it compounded to this head in about 2021 where they're going, no, like we just need to survive. Hungary has been a huge proponent of that. I don't think a country the size of the United States has ever seen something like that. And also country, whether someone like agrees with it or not, like the United States is still one of, if not the top dogs in the world. And so you further compound that fact onto it. And yes, these are very drastic and some would say radical changes. But on the flip side, just objectively, if you look at the national debt compound, have you ever gone online and looked that up?
Oh yeah.
It's pretty crazy. Yeah. Also, it's crazy how fast it's just compounding at a disgusting rate. And something does have to give, It's been fascinating too, again, I'm probably going to lose followers on this, not that I really care, but you've got people on both sides that have some opinion on DOGE, right, and the government efficiency. And you hear about these terms, and for a lot of people, it's really hard to wrap your head around how much is going to be saved, just because of the sheer size. I think as of now, this recording is mid-March, and so this will probably come out a couple weeks after. But the point is, as of this recording, there have been estimated $400 billion a year saved. Well, no one can wrap your head around that. Right. I've been curious what your take is in the long run on how that's going to affect things within the U.S. And I'm not even talking just this administration. I'm talking like 10 plus years, because as a planner and as a steward of one's money and my own, you've got to think beyond the next quarter or the next year. So
absolutely, Chris. Well, I think there was so much that you just mentioned that we need to bring a thread of coherence to in my view, to particularly for the listeners, to help really see where we are now. Because it's not just Kevin Howard seeing this. It's everyone who's listening is going to be able to see this as far as I'm concerned. So if we have different periods of economics. So I'm going to tell you a story. Okay. And it starts in 1971. And the significance to you as a planner, anyone in the investment markets is in August 1971, President Nixon closed the gold window.
Mm-hmm.
And the U.S. dollar officially became a fiat currency. Okay. Now, interestingly enough, so he did that. And 8 days later, Lewis Powell wrote the Powell Memo. I don't know if you know the Powell Memo.
Enlighten our listeners.
The Powell Memo, Lewis Powell was a powerful attorney who ultimately got selected by President Nixon to serve on the U.S. Supreme Court. He's one of the most significant corporatist judges in U.S. history. And so he wrote a memo to the U.S. Chamber of Commerce. And it really was an indictment to the American corporation, basically saying that the American corporations have lost control of the country. And that in order to regain the control of the country, they needed to spend more money than they've ever spent before to bend the government, the media, and the university system to the interests of corporate America. And then Nixon appointed him to the U.S. Supreme Court, and he proceeded to write some of the most important cases, extending rights of the U.S. corporation, this notion of corporations as people, mm-hmm. right, for example. And now they're super people since they have the ability to contribute endless amounts of money to political campaigns. Right?
Yes.
And if you look at those three institutions, the media, the university system, and the government, you can see just how profoundly they have been dominated by corporations. So, for example, in the university system, mm-hmm. most of the money that the finance professionals make come from research because corporations have essentially offshored. Well, they have invested in research and development through the university system, right? And that encourages those professors to go there to make money, which leaves their teaching assistants and less capable professors to teach what is being taught in the classroom to our students, right? That has a certain effect, by the way, right? So this is how corporations have influenced how universities are teaching our students, right? You will notice there's an interesting trend line between student-based protests from the 60s and the 70s through the last 40, 50 years, right? You're getting a little taste of it now, right? But for the most part, there hasn't been student-based protests of any consequence compared to the 60s and 70s. And
I see what you're saying. Yeah.
it's largely because of who's teaching them, right? And they're much more it's much more about the job that you're going to do as opposed to the scholarship that you learn when you go to school. And so that's the university system. In the media news used to be supported by the entertainment divisions.
Yeah.
It was a public service, right? Walter Cronkite, all that was public service stuff supported by the entertainment divisions. The corporations were able to privatize, get news to be for profit. CNN in the 80s and all those type of things.
Oh, yeah.
Which allows them to flood the zone. And now the person telling you the news is not a middle-class person like Walter Cronkite.
Yeah.
They're a person making $1 million or so a year,
Sure,
who now can be controlled.
Yeah. Well, there was a lot of profit in that. I mean, look, if you, I mean, you know the history way more on the economy side than I do, but I can tell you from like an investment world or like studying super investors, like we were talking about. Yeah. Love him or hate him, I mean, there's a reason why Warren Buffett has gotten to where he was. And a lot of people forgot that one of his, because he even said I think it was 2 or 3 years ago in his annual shareholder letter, he has made Berkshire what it is today. And this is a guy that's made thousands of buys and sells, okay, off of 12 investments. Now, he didn't say what they were, and you could speculate what some of them are. One of them was Cap Cities. In ABC. And you did the math on it. Like, yes, Tom Murphy was a phenomenal CEO. Fun fact, that CEO, he was so good that when they acquired the majority stake in that company, that publicly traded stock, that was the only time in Warren Buffett and Charlie Munger's career where they gave Tom the sole discretion of their shareholder rights for voting. So they never even vote, like they trusted him that much. But you had an amazing manager, CEO, in an industry that was pretty much unstoppable. Because the media, I mean, let's face it, entertainment sells. It is funny you mentioned 1971 because that decade sucked.
For a number of reasons. And so I am getting to the point, the idea is they made what, from the perspective of the American corporation and from the perspective of wealth, there was a point to the Powell Memo. And the point to the Powell Memo is America's commitment to shared prosperity, the Pax Americana, 1950 to 1980, when we had the greatest American middle class and the greatest American working class in the history of the world.
You'd say 70 to 80.
So from 1950 to 1980.
Okay, the
Pax Americana. Yeah. Okay, so the Powell Memo was written in 71 because after 20 years of that, new GI Bill, student loans, you have more people being educated, access to do it, starting businesses, ability to buy a home with no money down. All these things had created this bustling American middle class, right? The difference between CEO pay and the average worker was 20 to 1, okay? And what had it produced? Well, it produced a working class and a middle class that were far more able to hold power accountable. You had the civil rights movement. You had the equal rights movement. You had the anti-war movement. You had a media who came out of the working class who was able to take down a sitting president, right? Okay, this is the control that Lewis Powell was talking about. We had lost control. Power cannot allow that to happen. The cost of shared prosperity was too high. But here's the rub. Every time, greed is greed. Everyone who could make more money will make more money, right? Yeah. But the problem is history had taught wealth that if you consolidate too much money in too few hands, you have these massive depressions. The Great Depressions of the 1890s ended the Gilded Age. Yeah. The Great Depression of 1930s ended the Roaring 20s, right? So they knew that, okay, shared prosperity had produced the situation where they can't control the narrative, okay? But if we don't share the prosperity, recessions turn into depressions, and we get punished and start jumping out the windows like we did in 29. Okay, so how can we fix that? Well, Paul Volcker was part of Nixon's economic team.
Yes.
Who
Yes.
got him to close the gold window, right? The fix was getting the Fed to participate in a structure where when it came time for a recession or even a depression, wealth would be protected. Okay. And this is so fast forward to Alan Greenspan gets appointed, replaces Volcker, gets appointed by President Reagan. The thing he perfected during Clinton's administration was the first soft landing in U.S. history. Okay, this is the Federal Reserve. This is an activist Fed saying, okay, as a $20 trillion economy starts slowing down historically, it slows down to a loss, to where it's starting to contract. It never slows down, and then you could turn it around before it goes negative.
Yeah.
The soft landing is to turn around before it goes negative.
That's the idea.
That's the idea. Greenspan did achieve it. He did achieve it in 96. I think it was 96 and stuff like that. So first time the Fed was able to achieve it, but here was the problem: not enough pain. In other words,
hold on though. I gotta jump in too. Would you also though argue that I'm not even going to say Clinton got away with this or Greenspan got away with this, but that was the start of the .com boom, and so was it Greenspan dodging it successfully? Like, was that an actual soft landing and like crisis averted? Or did he happen to get, was he in the right place at the right time? Because let's face it, I don't think, I'm probably gonna get a lot of slack for this, I don't think it would have really mattered who was president 96 through 2000. Because you were making money. Economically, the .com boom was so crazy. You were making money hand over fist. Now, granted, my brother and I were very, very young at this time, but I can tell you, and my brother's going to agree with me on this, we used to go to Lake Chelan every summer, which is central eastern Washington. Okay, beautiful over there. And we would stay at this local resort, and I remember they had a restaurant it was 2 stories, top floor, bottom floor. And if we wanted to get breakfast there, and granted, my brother and I were probably like, I don't know, 9 and 7, something like that. You would wait for hours to get a spot, okay? Hours. And then you'd go to the lake, and it was packed. Every year, the crowds grew more and more and more. People were spending money on the boats and the jet skis. The lake was thumping. And in 2001, the summer of 2002, when everything, the dust settled, it was dead. And honestly, I don't think Chelan has ever recovered from that, because you go up there and it was like watching the metaphoric tumbleweed go by, and the waiters and waitresses are going like, hey, please sit down so we can serve you. And my point with that is people got away with being successful. And I'm not saying they didn't deserve it, but it's actually, I can make an argument, it's been very similar to what we've seen after the great financial crisis, okay? 2009 and 10 through really 2022. And even then, a lot of people have forgotten about 2022 because everything bounced back. You could have been an impressive idiot and have still made really, really good money. So that's why I just had to like push back a little bit on that.
No, I hear you. I will contend those two factors, the .com bust and what the economy was doing and what Greenspan was trying to solve for, 2 separate things.
Yeah.
The Federal Reserve, they are trying, okay, remember.
But it gets blended.
Well, these things affect each other. There's no question about it.
Yeah.
Okay. The idea was to break the back of shared prosperity. But you can't do that unless you fix the downside risk problem, which is their solution was to have the Fed be an activist Fed. So let's look at two scenarios, okay? So we tried the soft landing version, and the Fed can use monetary policy and interest rate policy to actually turn around a $20 trillion economy without it going negative. Okay, we can do that.
Yeah.
Then you have the financial crash of 2008, 2009. Okay, this is where they perfected how we're going to do this. This is where the solution that allowed wealth to consolidate so much money and not pay the price is private profits, public losses. Okay, and the Fed is at the center of that, right? Okay, so the soft landing fix doesn't cause enough damage to allow the working class and the middle class to get off the hamster wheel, to hold power accountable and stuff like that, like they were doing before, right? We need to keep them on the hamster wheel. We need to make them have to work harder and harder and harder just to stay in the same spot, right? So that they can't pay attention to what's going on. They can't hold power accountable. Okay, but when we do have a natural recession, 2008 or whatever, and they don't have much savings, and therefore they default on their loans, and therefore it causes the usual bleed, the spiral that leads towards a depression. We are insulated. How did we fix 2008? We bailed out Wall Street.
Yeah. We
bailed out. Okay. And the thing is, right, we didn't bail out the 8 million homeowners who lost their homes because of the shenanigans at Wall Street. And we can talk about that shenanigans too if you want. My point being is they have perfected between the Great Recession of 2008, 2009 and the COVID response, just how you help wealth and just give enough to the working class and the middle class to hold them at bay, right? And the final example is the CARES Act, how we dealt with COVID. Okay, if you go back to March of 2020, so we were faced with this scenario where we were going to have to shelter in place.
Yeah,
and there was a lot of drama on that. I'm trying to remember the name of the investment banker, a hedge fund manager who went on CNBC and did this desperate plea as to, democracy was going to end.
I know.
While he was secretly short in the market.
No, who?
Well, you think about that.
No, I know who you're talking about. Bill Ackman.
Bill Ackman, right?
Yeah,
exactly.
Yeah.
So it was right. It predated. Yeah. Okay, Congress is working on this legislation, the CARES Act, $2.2 trillion. How we're going to fund Project Warp Speed, how we're going to support hospitals and on the state level, how we're going to help states deal with this. Then we created a couple of pools. We created the pandemic unemployment insurance, the $600 a week, pool and stuff like that. We created the PPP program for small businesses.
PPP loans.
Yeah, PPP loans, right?
Oh, yeah.
And then let's compare these two. And then we had another pool, and it was $500 billion for businesses of over 500 employees. The large corps.
Yeah,
$75 billion went designated to the airline industry and to the cruise line industry, just for them. Okay, so you had $425 billion. So let's compare how we used that $425 billion to how we used the $300 or so billion for the PPP program.
Yeah.
Okay, the $300 or so billion we gave to the Small Business Administration, who administered the program. Okay, and until those funds ran out, and we did a second tranche ultimately. So that's how we did it with the funds, the $425 billion. For the large corporations, we gave that to the Federal Reserve, who created a loss reserve, a 10% loss reserve that allowed them to lend to those corporations $4.25 trillion at the federal funds rate. Right. Okay. So, right. Okay. So take note, no airline, no Hilton, whose occupancy globally was like 8%, right? No one went bankrupt. Okay, a third of all small businesses in the country through the PPP program went bankrupt. And it wasn't because they weren't good businesses. They couldn't access the capital.
Yeah.
Right. It wasn't enough. But the reason why is because we created a loss reserve for the large corporations. We didn't do that for small businesses. We provided the money and lent it out pure. So once the $300 billion was gone, it was gone. We had to come up with another thing. See how the different treatments.
Oh, yeah.
Okay. The effect of this is take a look at the economic performance 2020. At the end of 2020, GDP in the United States contracted 3.5%, which was twice as much as the Great Recession, which is like 1935 level. But that's because we shut down 80% of the economy for like 3 months.
Yeah, that's a different beast.
It's a different beast. Yeah, we did that to ourselves. But okay, so that's the real economy, real productivity contracted. Okay, the S&P 500 went up 16%. The Russell 2000 went up 18%. The NASDAQ Composite went up 43.6%. Why? Because the Federal Reserve opened up the floodgates and pumped $4 trillion into the market, right? At the federal funds rate.
Yeah.
Right. And what did these companies
Which
do?
was low at the time.
It was 25 basis points.
Yeah.
Right. So right.
Yeah.
And so what did people do? They didn't reinvest in research and development and stuff like that. They bought their own shares back. Look, I don't want you're right. You said we're not going to name names, but the fact is that's what they did.
Yeah.
And it drove share performance.
We're actually, really quick, we're actually working on getting Bill Ackman on the show. So
Yeah.
So I'll ask him about it. I don't think he'll say anything about it, but I'll ask him about it.
It's watch for the market makers.
Yeah.
They make the market for a reason.
I understand that. That's always been something fascinating to me too, how you got a lot of these people that will come out and they say things. And the one person that's actually been really good his entire career is Warren Buffett. Like he's very open on not, because he's sent one tweet in his entire life, but like he could go and tweet,
sure,
before. Sure. I mean, the SEC would be knocking on his door, but it's always been fascinating to me how a lot of these people can get away on every side with saying certain things. But then it also gets gray because it's like, okay, well, are you actually promoting your business? And that's what you do in research and development and marketing, or are you playing the game? And it's a lot of gray. And then you just got to go back to the guttural instinct of trust and prudency in whoever you're looking across the table. I mean, you were in banking.
Yeah.
Like banking, all banking is, a lot of my banking friends are not going to like me when I say this, but like all banking is if you're my banker and you're looking at me the entire time you're schmoozing and kissing my you-know-what, you're just thinking, is this guy going to pay me back?
That's all
it.
Is.
And it could be a 15-second meeting. You look at the balance sheet, you look at the P&L statement, you look at the cash flow statement, you look at the guy or gal in the eye and go, is this dude a schmuck or is he going to pay me?
Yeah.
And that's it.
Yep.
I mean, so for bankers out there, you could save a boatload of time by just doing that. But I will say, going back like full circle, because you go through the 70s, you go through the 80s, you go through the 90s and then 2000s, and then you get this taste in your mouth of printing money, reinvesting it. And in our book, we call it capitalizing on the spread. If you have a 2% loan, you take that out to go and invest and earn 10%, you just earned 8% on the spread. That's what everyone does. Yeah. That's banking 101, okay? However, now we're at this point where it's kind of like a holy crap moment. And so you've got all of these cuts, which I do feel bad for a lot of people. And we're talking like innocent government employees that have been let go. And these people very well may be phenomenal employees, but that division might not even be needed in the first place. And unfortunately, it has never been, because a lot of people will say, oh, this has never been done before. Not true. Bill Clinton and Al Gore did a DOGE light.
Yes.
Right?
Yes.
And they actually got a lot of this done, but not to the extent. But again, you can get away with it when money is just flowing like fine wine. And then I've always been curious because I was researching for this show. The whole concept of DOGE was created under Obama, and I forget if it was his first or second term, but the whole concept was to have a independent, I don't want to call it party, but an independent entity, basically give guidance and of counsel to the president, whoever that may be, of saying, all right, this is what we found. And not just the president, basically, the president, Federal Reserve, the whole 9 yards. This is what we found. This is what we recommend. But at the end of the day, here are the facts. You have to go and do what you have to do. The whole DOGE thing I find fascinating because in many ways you think, okay, yes, you're cutting a lot of the expenses that probably needed to be spent because, again, you look at the national debt and it's just going through the roof. The thing that I always find fascinating is it's like if you cut, okay, so I have no idea about your financial situation whatsoever, but I'm just going to spitball in freestyle here and say that you and your wife spend or have expenses of 10 grand a month. I'm making it up because it's an easy number, okay? If I found in your expenses that the two of you could free up $3,000 or a 30% decrease in expenses, that would move your needle. I don't care who you are in this world.
Absolutely.
So on an annual basis, after 2 or 3 years, you start to see that compounding. You're going to feel that. You're not going to feel that for a month or 2 months. It might feel good, but you're not clawing yourself out of anything. And you're not even going to see that over a year. So my whole thing is, I was just curious your take, because I think that regardless of someone's opinion, it's going to take years to actually see if this cutting is actually going to be of benefit. But I will say, if you've gone on the national debt website, you've started to see that compounding slow down a little bit, which is interesting.
It is. No, again, I don't think DOGE. I don't think the cutting that Elon is focusing on right now. I don't think it's about the number. I don't think it's about the percentage of savings they're looking. It is about dismantling a federal infrastructure that was persistent regardless of administrations. That presidents who would come in were constrained by that infrastructure.
So you're saying the savings is a byproduct of the actual?
Oh yeah, well,
yeah, I see what you're saying.
It's a byproduct of the dismantling of infrastructure of government infrastructure that was not serving most people.
The actual people in which that's
the whole
voted
thing.
upon.
That's exactly right.
Got
This is why you're not getting the massive protests you're getting some protests from people who are affected. And I'm not saying the people in government, no, they're good people. They're just you and I.
Yeah.
The problem is that they're there to serve the American people.
Yeah.
And what happens when you don't serve the American people in a democracy is eventually the American people will stand up and say, time to go.
Well, I mean, it's as simple as running a private business.
That's exactly right.
Remove the fact that my brother is my brother. He does a phenomenal job for all of our marketing. If he didn't, he would not be doing what he is doing for me. He would be fired.
You would not be able to afford to have him do
which,
that. Exactly.
Tyler not going anywhere. But it's one of those things where you know what I mean?
Yeah.
It's interesting because I will say in governmental roles, I mean, we have clients in government and they're all extremely good at what they do. Okay. And that's not just me with a bias because I absolutely love these people. I know they're good at what they do. And you can tell when someone's great at what they do just by how they carry themselves. And it's by what they don't say. It's not what they do say.
Yeah.
Okay.
Yeah.
So, it's never really been done where it's like, oh my gosh, these millions of people are, and then you compound the working from home thing, which I'm not even getting into that, but there are people that are going to use that.
Oh yeah.
Duh.
Yeah.
Duh. I mean, for crying out loud, I mean, if I wasn't me, I would probably do the same thing, right? I would probably use that. I did want to ask you, well, actually, before I get into Fannie Mae, because I really wanted to talk to you about that, because I don't know if you've been following what's going on with that as far as taking private, but I did want to, it's not even push back, but.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Pushback, Chris.
It's really even not a pushback, okay? It's one of these things where a lot of people will come out and they get upset with, yes, the wealth is going to the top, whatever it is, 1%, 10%, whatever the case may be. And recently I've actually been studying like the history of interest rates and economies and, how did we get to this point? And then again, past performance can't guarantee future results for compliance people that are watching and trying to ruin my life. But it's a valuable indicator on what could potentially happen. Okay. Very politically strategic with my words, so I don't get in trouble here.
Understood.
So it's one of those things where for me, I think of, okay, if you go back to 2008, yes, did the banks get away with a lot? Of course they did. Okay. But there wasn't just one to blame. Like there were a lot of people that bought into this and played the game. And unfortunately, and I'm not even talking about the people that just didn't have a clue and they just got financially shafted by 2008. I'm talking about the professionals in my industry that decided not to actually go and put in the work and the effort to actually learn all of this stuff. It's the same thing in 2015. It's the same thing in 2018 when there was not a single asset class in general that had a positive year. It was one of 3 years over the last 125 years of recorded history. And then you even had the fallout in 2020 and then 2022, where a lot of people lost money. It's fascinating to me because people keep talking about how we need to fix this grandiose system, dismantle. And the biggest problem is in the mirror. It's in the mirror. Like no one actually does the work to learn this stuff. And I'm not saying you're going to wake up tomorrow and you're going to be the next Warren Buffett or the next Mark Cuban or any of these billionaires. Like I'm not saying that because you got to have screws loose. You got to have a little bit of luck and you got to be ruthless in getting to that point for better or worse. But what I am saying is there has never been an easier time. And this isn't even me being biased. This is purely objective. There's never been an easier time to become financially successful. Ever. And somehow, some way, and I'll get off my soapbox, people are still screwing it up because they want the easy answer. Like becoming wealthy, not rich, becoming wealthy. It is a very simple process. It's not easy. We talk about this all the time. And I am so tired of people drowning in the pointing, in looking to blame others. It's like, no. You need to look yourself in the mirror. You need to figure out your gaps in knowledge and you just need to go fill them. And then you need to act on it. Like it's literally that simple. And then you take that individualism and compound that societally. You cannot help but have a really, really successful country. And regardless of administratively who is in the White House, right? Whether it's Trump now, Biden last time, Trump before that, Obama, it's always been this group thing. And, and again, I wasn't alive during Reagan. I don't even think I was a thought during Reagan. Okay.
Maybe believe it, I was serving in the military during Reagan.
Okay. Yeah.
So,
I might have been a contemplated thought toward the end of his second term. But the one thing that what I have studied is, he was very much about that individualism. It's like you pull yourself up by your bootstraps, you figure it out for your family, and then the result of that is you will become successful, not even just in finance, but just in general. And so even though there are all of these cuts going on and all that, my fear is people are looking for like this group answer, and it's never going to happen. So again, I'm off my soapbox. I had to get that out.
No, I appreciate it, Chris. I just want you to know the point of my story is really to tell us the truth about where we are. It is not about blaming wealth.
Yeah.
I wish Charlie Munger was sitting right here. I wish Warren Buffett was sitting right here right now. And the reason why is this.
Preferably alive.
Because
Yes. Charlie's been,
I know Charlie's passed.
We can prop him up.
No, we want to bring, hey.
Yeah. Taxidermy, man.
Why I'm saying that is the problem that I've just described, the story that I'm describing, they broke capitalism.
Meaning?
In the effort to create a scenario where wealth would not pay the price for consolidating too much wealth in too few hands, they broke the system. And what I'm saying, and so right now, there used to be a data point that measured the predictability of stock performance.
Mm-hmm.
Okay, and in this data point, and the reason for this is, and this is why people like Warren Buffett were able to make the money that they did, and why it's called earning. He earned that, right?
Sure.
He found value.
Yeah.
Right.
Yes.
Okay. Is because it used to be really simple. Companies that had that persistently made earnings, you buy them on the cheap when there's a bad story or whatever the circumstance, hold them for the long haul, and the market will give you the value.
I mean, that's Ben Graham value investing 101.
Yes, 101, right. It's really basic.
Yeah.
That works when that's what drives the market.
Yeah.
The problem is the fix that they have done since 1992. It's a beautiful benchmark. We're in 2025. Okay. So you got 33 years.
Mm-hmm.
Federal debt was $4 trillion in 1992. It's almost $37 trillion now.
Yeah.
Okay. So up to 1992, that's 216 years in the history of the United States, $4 trillion. 33 years.
Yeah, exactly.
Right.
Yeah.
Who benefited from that?
Mm-hmm.
Was it just an accident that the Federal Reserve held interest rates historically low for over a decade?
Yeah.
Right.
And kept them going lower and lower.
And kept them going, right.
For sure. Yeah.
During the time of that massive ramp up.
Mm-hmm.
So what I'm trying to say is it held down the compounding of that ramp up.
Mm-hmm.
This is wealth looting the Treasury. And why I say this is proof of the pudding, it's not conspiracy. Where did the money go?
Mm-hmm.
We can look at the demographics of the socioeconomic demographics of the United States.
It's very black and white.
Yeah, from 1980 to 2020. So while we were running up $30+ trillion in additional debt, the benefactors weren't the American middle class. The benefactors weren't the American working class. The benefactors weren't even the upper middle class. The benefactors were way up in the point such and such, because we created the greatest, most wealthy billionaire class ever.
Mm-hmm.
We have billionaires who have more wealth adjusted for inflation than the entire Gilded Age. The Rockefellers, the Mellons, all of them combined. Okay,
for sure.
That is what is happening. Okay,
yeah,
that's where the money went. You can't. This is so much money you can't hide the money, right? Okay, and so what I'm trying to say here is that that was not just the benefit of technology. That was not just globalization.
Mm-hmm.
So you can lower your costs by finding the best quality, low cost labor and stuff like that. It wasn't just that. It was doing things like changing the UCC code in every state from 1994 to 2004 to change our personal property rights and shares. Okay, starting and this is on the state level. And this is every state, Alabama and California.
Yeah.
I don't think Alabama and California do anything just about the same.
Yeah.
But in this case, they did.
Yes.
Okay.
Yes.
Right.
Yes.
Okay. So we're talking about historically when you bought a share of stock,
mm-hmm.
you get your shares and you have a personal property right.
Yeah.
And so
it's like a receipt.
Yeah, it's like a receipt.
Or was.
And the fact that a broker is holding your shares and investing them for you or what have you in some sort of account doesn't mean you don't have your personal property right historically. And that if that broker goes bankrupt, the officer of the court or whomever representative would contact you and say, what brokerage firm or what account do you want me to send your shares to or whatever. That's how it used to be.
Yeah.
They changed that to say, instead, we have a claim on the value of our shares, a claim on the value, and it's a low priority claim. Okay. So then they made another change to the UCC, same time. Every one of the UCC codes, all 50 states, that the holder, the intermediaries, can use your asset as collateral for their financing without your approval. Okay.
Yeah.
So what does what does that do? That means that you have assets, and this is a part of the explosion of the derivatives market.
Yeah.
Is the idea that holders of and this is at a time that we securitized everything.
Yeah.
Okay, so it's not just buying a shares of stock. Your mortgage is securitized, right? Okay, all right. So there's so by doing that, what that has done is allowed these holders of our assets to make bets, to invest, to generate much more U.S. dollars, because that's how banks create money through financing. If the holder of our shares, of our stocks, right, can make bets on those assets, notwithstanding what we do, right, then that's wealth that's being created. But, like double dipping on the asset, right?
Yeah.
This is the nature of the derivatives market.
Well, I mean,
Right.
part of it is the concept of something that is completely legitimate, and it's the concept of the insurance float. And so, but then when you take that concept where it's legitimate, right? Because in insurance, and just for my listeners, just so they know, right? So a float is a lot of these insurance companies, when you go and you pay your premiums, the odds of you actually needing that death benefit, knock on wood, are very, very slim. But there's an actual way to calculate when approximately you will need to pay that money out. So a lot of these insurance companies, what they do is they actually don't need to reinvest into the businesses themselves, because actually by doing that, the insurance company they're not actually gaining more value. Okay. So what they do is they take that money. They know that they might not need to pay that to you for, 30, 40, 50, 60 years. And then they'll go and either distribute that to shareholders or invest it in something else, and they capitalize on the spread. Like that's float 101. You could make the same argument with, there's a company we follow, ADP. ADP is a master at float. Amazon, whether people like them or not, when I get my commissions for my book sales, I get paid in arrears 3 months. And why? Because they keep that money in the bank. Obviously, they want to make sure that if there's a return and all of that, they compensate accordingly. But then they take that, they're earning that interest on the float, which, you're not earning a ton of money, but you are if it's billions of dollars.
Of course, yes.
Right? But then you securitize everything. That compounding gets really, really, really scary. That does bring me up to, because you worked at, and I can't remember, was it Fannie Mae or Freddie Mac?
Freddie Mac.
Freddie Mac. Okay. So have you been following what's been going on with that? Because one thing administratively that a lot of people have been talking about is taking those private.
Yes.
So I'm curious, and this is a really simple question. I've been excited to ask you it because I have no idea where this is going to go. What do you think would be the result of those actually being taken private?
So you're talking about like $8 trillion between Fannie and Freddie.
Yeah.
Of U.S. housing. Well, of course, the devil's in the details.
Of course,
and how they do it. And so, no, I would say the short answer from my perspective is that this is not something that I've been following acutely to where I would want to speculate as to how I see it turning out. But that is how it should be. They were intended to be, these pseudo private, and only pseudo because they're so significant.
Yeah.
I mean, they are the U.S. housing market, but they provide that stability.
Yep.
They provide the lower cost of finance, the lowest cost of financing for U.S. housing, which was the theory behind making housing available to the broader working class. And so
and commercial.
And commercial, yes.
Yeah. I just had to throw that in there for my listeners.
Absolutely.
Yeah.
And so I am an advocate of that being unwound and them going private.
Mm-hmm.
I think that, again, it's another story for why they wound up, in the federal government in the first place. It's all tied. It's all tied to the financial crash of 2008 and 2009. So I can't add much light to that. But I would like to take the moment just to put a bow on what we were saying, because I'm not fatalistic about where we are. But what I'm saying here is, so the effect of these things, like changing the UCC code in every state, led to a wonderful example that can give us some guidance for the future. If you go back to the Lehman Brothers bankruptcy, okay. So,
by the way, I remember that day. Even though I was a sophomore in high school, I remember that vividly.
Right. The reason why that pretty quickly led to a run on investment banks is because in the filing of that bankruptcy, J.P. Morgan Chase seized the assets of Lehman Brothers. I mean, so if you were the wealthier enough investor to have Lehman Brothers investing your money for you, right? You would not have assumed that if Lehman Brothers went bankrupt, you couldn't get your money back. You couldn't get what they were holding for you, right? But they were blocked from being able to do that because Lehman Brothers had taken out debt secured by their customers' assets. As I said, under the UCC code, it was legal. And then when we changed the bankruptcy laws in 2005, we gave the big four essentially they not only have top preference, you can't even bring a fraud claim to challenge their preference. And it was so funny that the bankruptcy judge laughed in writing. I said, it's true. This is what the law says, that you can't even accuse J.P. Morgan of fraud.
Yeah, you can't lift a finger.
You can't lift a finger.
It's similar to, actually, it's not even similar. It's parallel to the pharmaceutical industry.
Okay.
Yeah.
Okay. You can make that connection.
Well, no. Do you see what I'm saying? Like you can't, it's kind of like, well, tough luck.
Well, I know, for example, it's
not the exact same, obviously, but
in the pharmaceutical industry, the vaccine manufacturers have they have a liability protection, right? That you're absolutely right. Yeah. So in this case, therefore, investors who held money at Goldman and other places now realize that their money is at risk if these investment banks
if Lehman goes down, like what else could happen? I remember, so right before we came in here, one of our past guests, and he's become a friend, Guy Spear, he wrote in his book, The Education of the Value Investor, because he was at, I think it was D.R. Horton, and then I believe he may have had, Guy, I'm sorry if I'm screwing this story up, but he may have had money directly or indirectly at Lehman, and he remembers watching that and going, did my entire portfolio at the time just evaporate like overnight, which would be crazy. It's like, I mean, we oversee $150 million right now. And I could not imagine what that feeling would have been like if I go online at LPL and then it just is possibly gone. You get the email notification going like, hey, we're going under. Now, granted, feeling pretty confident LPL is not going anywhere for a while because obviously,
That's right.
Well, and a lot of things that came out of 2008, 9, and 10 were good things from I can't believe I'm going to say this, but like there were good regulations that came out of that.
You need them sometimes.
You do. Yeah, you do. Like a lot of people think like I am, like just total anti-regulate. That's not the case. Okay. I think a lot of it's overblown. I get why it's there because you got a few bad apples that screw it up for everyone. But there were a lot of good things that came out of the financial crisis, so that a Lehman Brothers couldn't occur, to the best of the abilities. I actually did. I wanted to ask you this. So I tested my teammate Betty on this. So first off, can you name all of the 8 too big to fail banks? I wrote them down. I tested my mom on this last night too.
So let's see.
Yeah.
So there is Citibank. There's Bank of America.
Yeah.
There's JP Morgan Chase.
Yep.
There's Wells Fargo.
Yeah.
There's let's see. Now we're going to get into the
Some of them are tough.
yeah. Is State Street one of them?
Yeah. I can't believe you got that one. Good for you, man.
Yeah, because they're let's see.
You got three more.
Let's see. Is it Goldman?
Yep.
Goldman?
You got two more.
Let's see. I know it's so interesting because it's not. You would think like the fifth largest commercial bank is U.S. Bank, and it's not one.
Nope. Nope. You're right. You got two more.
I'm done, my friend.
Okay. So Morgan Stanley, which I get why people wouldn't call that one because yes, it's a bank, but it's an investment firm.
Yeah.
Okay. And then Bank of New York Mellon.
Yeah.
Yeah. Which I was like, really? That was one of them. So my question was though, so not only the next 4 years, just because also I know we're going to be wrapping up here soon, but over the next 4 years and beyond, because you got these 8 too big to fail banks in the banking world. Side note, that's beyond my circle of competence. It's just it's a tough world to figure out. A lot of my banking friends are like, dude, it's so easy to value. I'm like, well, good for you. Okay, cool. You're smarter than me. But for me, I do wonder because in the world of banking now, like if you start a bank, the only reason you started it was to be acquired. That's it. And then there comes a point where you're unacquirable, So locally, in our community, so we grew up with Columbia Bank, and then Columbia Bank got bought by Umpqua, but that was kind of a mess. So I call it Columpqua because no one knows what the hell's going on. But that's beside the point. They're now getting to this point where it's like, okay, you're this big. The buyers of you are few.
Yes.
Right. And you're seeing this consolidation. And so like, if you had to guess out of those 8 banks, because someone's going to win. Someone's going to win. I don't think we're going to just have like one bank in the United States. But which ones would you say, this is just more of a fun question, are going to be the ones that make it? Because I bet you out of these 8, someone is going to go down. I'm not saying like Lehman Brothers go down, but they're either going to be acquired or merged. Because you can't, what was I reading? In the United States, I think there's like over 1,000 different banks. And then you go to like any other country, there's like 2 or 3. Like, and that's it, So which ones do you think are gonna make it?
They're going to make it.
Yeah.
Oh, well, I know. Okay. I'm confident State Street is going to make it.
Yeah.
I'm confident that New York Mellon is going to make it. There's reasons for that. I think Goldman is at risk unless they acquire. I think this is just my opinion.
Yeah.
Unless they acquire, and see that's the problem. They're not going to. Well, in my view, Wells is too problematic. So
yeah, but Wells is huge.
Wells is huge.
Fun fact: Wells has the largest asset size of any 401k in the world. Look that up before this episode.
All I would say, is that so they are going whether they make it or not. I don't know.
Yeah.
But it's not going to be based. It's going to be because they stand alone and they make it.
Yeah.
I think Goldman needs to add someone, and I think it's one of those top 10.
Have you seen what their CEO is doing on the side? Goldman's CEO is a world-renowned trance DJ and house DJ.
Really?
Yeah. And he kills it.
That's fantastic. No, I did not know that.
Oh yeah, you got to look it up. Yeah. Well, and there was people were kind of like giving him slack and all of that, but in his defense, his thing was, it's like, dude, it's my passion and I do it outside of office hours. Now, I don't know what, I'm not saying if you're watching the CEO of Goldman that you actually take drugs, but like I would have to take a copious amount of drugs to have that level of excitement in my life. It's funny you mentioned Goldman too, because if I had to look at all of these and I'm just spitballing here, Goldman would be one of the ones I would say is like more safe because think about where all of these professionals from the Treasury go or come from.
Yeah.
They all come from Goldman.
Oh no, that's right. But they still have to solve. They need a commercial bank.
Yeah.
I mean that's what I'm saying. Of the certain ones, they're still looking for that fit, and I think they're going to find it and number 5, number 6, in that range, number 7
Yeah.
of the commercial bank.
Yes. Yeah.
We'll see how that turns out. But the biggest thing that I see on the horizon coming up, relating to where we started this conversation in terms of the tariffs, is how we are moving from a unipolar world. So the geopolitics is now going to inform the economics. We're moving from a unipolar world where the United States was the only superpower since the fall of the Soviet Union in the early 90s, okay, to a world of superpowers in different regions. The new Secretary of State did an interview, his first major interview, where he spoke about this very thing. It's Russia, it's China, it's the United States. We're going back to zones of influence.
Yeah.
Right. Okay. This is why you hear Trump talking about Greenland and you talk about the 51st state in Canada.
Sure.
Because these are zones of influence where the United States wants to start. Okay. So therefore, we have to pull back our production into our zone of influence. So in other words, we can't rely on China as a competing superpower, to produce all our pharmaceuticals and on and on and on and on. Okay. So with all that in mind, that's why the tariffs, which will require congressional support, because we're talking massive tariffs. We're not talking just, we're talking a level of tariffs that will convince capital to move the production assets back to within the United States or in our zones of influence, right? That is going to cause a level of disruption over the next 2 years. That again, for a $26, $27 trillion economy, it has not been done at this level. So let us see. Maybe Poland, that's fine. But this. So that's one where I would say, from an investment standpoint, it's going to be. Think about 1980, when how did Volcker break the back of stagflation? 20%, right? Okay, he raised the federal funds rate 11 percentage points in 1 year. Okay, and we had the deep recession of 81, and then you had this double period of economic growth. This next 2 years is going to be some pain as capital is reshifting those assets, those production assets, back into the United States and elsewhere, if he's successful, right? And that's the externality that will dominate economic performance.
Yeah.
And this is what I'm saying. It is not. We are experts in the microeconomic realm. In other words, we offer advice to individual investors. We offer advice to individual or services to individual businesses and stuff like that. We analyze, we recognize whether they're worth, what they're capable of, whether they'll pay us back or not, what their goals are, and then we devise a strategy. Okay. It's the macro that is smothering that analysis, because it's these factors that are changing the cost of our money, that are changing. Is it going to be the Magnificent Seven or what? Who is driving this market? It is not earnings. It is not high quality earnings that used to be predictable, that built Buffett's portfolio and Charlie Munger's portfolio. This is not what we're dealing with. We're dealing with companies who are benefiting from all types of interventions and then they're taking profits. They're not doing research and development. They're not. There's so much distortion in this economic performance that it's hard. How do you predict, in this environment when these externalities are just smothering the micro? And this is what I'm saying. So to me personally, I'll be the first to say, I am moved towards cash. I am because I can't predict this market, and it's not because I don't understand it. What I understand is that it's not being driven by fundamentals that produce earnings that have a value. That its predictability builds a PE, right? This is
sure.
That is not the market we're dealing with anymore. And if that's the case, then how do you? It's going to be, what is the next externality that I could play, And I don't want to play that game. And Trump is only accelerating that process, because this is going to come to the head. He's either going to succeed And we're going to have a massive disruption as capital is finding its place back in the United States, finding its place. What's going to happen with Taiwan and the chips, the whole 9 yards. That is coming to a head over these next 2 years, and so that is I believe that's where we are, and I told you where I'm at. So
yeah. No, dude, that is great. When I'm getting the wrap up from my team, man, and so that is a great place to stamp this. We will put the link of your book in our episodes. But dude, this was fantastic. We're gonna have you back on sometime soon. Okay.
Indeed, I would love to come on. I would love to come on with any of the Buffett proteges that you know, because I know you're one yourself.
Yeah.
And let's have that discussion as to whether or not, if he started today,
mm-hmm.
how would he play?
Yeah.
Because in my opinion, that market doesn't exist anymore.
Yeah. Well, and I'll link it there, and we'll talk about it at lunch. But thank you, man. I appreciate it.
It was a pleasure. Thank you, Chris. This was fantastic.
Awesome. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Freddie Mac, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. An investment may not be made directly in an index. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. Russell 2000 Index is a small-cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. NASDAQ Composite Index is an unmanaged index and measures all NASDAQ domestic and international-based common stocks listed on the NASDAQ. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Kevin Howard and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial. LPL Financial California Insurance License Number 0518721. LPLIA California Insurance License Number 0B91442.